Okay, for as long as people have been investing, there's been this one huge debate. It's like the heavyweight championship of the financial world. You've got the active stock picker in one corner, promising they've got the secret sauce to beat the market. And in the other corner, the passive index fund, which basically says, hey, if you can't beat the market, just be the market. Well, today, we're finally going to settle the score.
So yeah, who actually comes out on top in this fight? The answer, and I promise you this, is way more interesting than you'd think. So let's just dive right into the cold, hard evidence and see which one of these strategies really wins.
You see, at their core, we're talking about two totally different philosophies. The active approach, that's all about skill, right? It's about hunting for those hidden gems, trying to be smarter than everyone else. The passive approach, though, that's a game of odds. The goal is just to capture whatever the market gives you, but do it as cheaply and efficiently as humanly possible. So how do they actually stack up?
All right, first things first, we're going straight to the numbers. And honestly, the whole case against active management, it really starts with one single, incredibly powerful number. That's it, 0.02%. That's the annual fee on some index funds. And that right there is the massive, undeniable advantage of passive investing. You got to think about it this way. Before an active fund manager even makes their first trade of the day, they're already starting in a hole. They don't just have to beat the market. They have to beat it by enough to cover their much, much higher fees. And as it turns out, that is an incredibly high bar to clear.
And look, this quote just nails it. It comes from a really important study by two researchers, Crane and Crowdy. And their conclusion is pretty stark. What they found is that if you're a typical investor, someone who doesn't like taking crazy risks, then just blindly picking a random active fund makes no sense compared to picking a random index fund. But why? Well, the reason is buried in this really powerful statistical idea. The term for it is stochastic dominance. I know it sounds super complicated, but the idea behind it is actually pretty simple. Crane and Crowdy discovered that the whole range of possible outcomes you can get from index funds just statistically dominates the range of outcomes from active funds. Think of it like choosing between two lotteries. Lottery A gives you a tiny chance at a huge prize, but a really high chance of losing your money. Lottery B gives you a pretty good chance at a solid prize and a way lower chance of losing. Which one do you pick? For most of us, it's Lottery B. And that's basically the relationship between active and passive funds.
So here's the bottom line. Yeah, it's true. A few active managers really do knock it out of the park. But the potential reward just isn't big enough to make up for the very real risk that you'll end up picking one of the huge majority who don't beat a simple, cheap index fund. The math just isn't on your side. So, case closed, right? Passive wins. Well, not quite.
Because this is where the story gets really fascinating. Just when all the evidence seems to point one way, you find out that even if passive investing is the smartest choice for your money, the entire market actually needs active managers to work properly. And this brings us to this huge, kind of weird paradox. If picking an active fund is, statistically speaking, a mistake for most of us, then why do they even exist? Well, it turns out they provide two hidden but absolutely vital services for all of us. First up is what's called the governance problem. An index fund owns hundreds, sometimes thousands of different stocks. I mean, the average one holds over 300. Because their fees are so low, they just don't have the time or money to keep a close eye on the management of every single company. So what happens? Well, research shows they're way more likely to just vote with whatever the company's management wants, even on really controversial stuff. But active funds, they own fewer companies, so they have more skin in the game for each one. They act as a check on corporate power, holding executives accountable. Without them, power basically shifts from the owners, the shareholders, to the managers, and that can lead to some bad decisions that hurt the company's value for everyone. And the second thing, which is maybe even more important, is the efficiency problem. The best way to think about active investors is like they're the market's police force. They spend all day, every day, looking for stocks that are mispriced. The famous economist Paul Samuelson pointed out they're amazing at fixing what he called micro-inefficiencies. Making sure that Ford's stock price makes sense relative to GM's. All of their research and trading is what makes stock prices actually mean something. Passive funds, on the other hand, don't do any of that. They are price takers, not price makers. They just buy at whatever price the active investors have already set.
Now, take a look at this chart because it shows you exactly what I'm talking about. As the number of active investors, our market police, goes down, the overall inefficiency in the market can actually go up. And here's why that matters to you, even if you're a passive investor.
The fewer people there are doing the hard work of figuring out what companies are really worth, the less reliable stock prices become for everybody. The whole system kind of relies on them doing their homework.
So that brings us to the final verdict, where we have to somehow make sense of these two completely opposite realities. On the one hand, passive investing is, without a doubt, the most rational choice for most individuals. But on the other hand, the entire system needs active investors to keep it honest.
And here it is, the solution to the paradox. What's best for you and your portfolio isn't the same as what's best for the market as a whole. For you, individually, the data is just overwhelming. Cheap, passive index funds are the way to go. But for the market to actually function, it needs that army of active managers doing the hard work of research and keeping corporations in check. In a way, passive investors are kind of free riding on the hard work of the active investors. They get all the benefits of an efficient market without having to pay for the work that makes it efficient.
This table really lays out the whole trade-off perfectly. With passive investing, you get super low costs and you'll always match the market. But you're not doing much to monitor companies and you're totally relying on others to set the prices. Active investing is expensive and yeah, on average it underperforms, but it's the engine that actually drives market efficiency and corporate accountability. You can see how they kind of need each other to exist.
And that leaves us with one last, really big question to chew on. Passive investing makes sense. It's smart, it's growing like crazy, but what happens if it gets too popular? I mean, if everyone decides to just be a passive investor, who's actually left to police the market? Who's doing the work to figure out what prices should be? It's the great paradox of modern finance, and one we're all going to be watching play out.